Hey traders, Raghee here, and in this free recap video, which we will take this conversation to the premium video, but I think it's really important to talk about today's sell-off. Not that I'm going to sound any kind of panic alarm. I've been a bear. I'm just a bear who's realizing that the FOMC, like we all did between December 26th and January 4, has single-handedly propped up the market with the pause in rate hikes, which actually does represent a shift in monetary policy. So with the FOMC coming off this hawkish, this tightening cycle, what we now have is the market really having to decide that, one, a pause in rate hikes, two, keeping a larger balance sheet now, rather than the 50 billion per month roll off. We're going to be closer to somewhere in the 30 billion, I believe. But keeping a larger balance sheet does inject more liquidity into not just the US markets, but globally. That has propped up even markets like the EWI. Italy is in a recession, gang. Okay? And even markets like this are heading higher. And this is what U.S. central bank monetary policy can do to equities worldwide. Okay, what's really interesting though about today's sell-off was, one, the size of it. Two, the broadness of it. It wasn't just large caps, it wasn't just tech, it wasn't just financials, it wasn't just small cap, it was everything. And I think what's really interesting about a move like this is we are starting to create the same type of price action. And actually the Dow was the worst example of it. Let me show you one of the better examples of it. And that would be the Nas and the Russell. We're starting to see maybe signs of a similar type of rolling top. I think it looks better on the Dow and S&P because tech, high beta, high momentum has been largely where this rally has been going. But I think we're starting to see something not quite the same, but similar, especially on the Dow, and that is this idea of a rolling top. Okay, why does today's candle get my attention? Look, I want to be a buyer on pullbacks. In fact, we have been. Right? We have been buyers on pullbacks. So this is not coming from someone who's holding on to shorts and is simply talking their book. No, I'm by and large right now positioned in the market to benefit from continued risk appetite. But I have to be aware, in the same way that I was in September and October, where we kind of led the futures room into buying more XLU, buying more TLT, buying more gold, looking at a lot of the markets that are going to be able to smooth out that longer term equity curve that everyone's looking at, rather than this kind of thing that people call an equity curve for their investments. So here we are, winding down into the latter part of March, where I'm going to look at every quarter rebalancing my portfolio, and it's not going to be any different than how I guided traders back in here. Bonds, bond proxies, we actually had quite a bit of US dollar back then, still do. Gold, we started adding things like construction, we started adding home builders, we started adding staples selectively, healthcare selectively. So these are the kind of things that we did. Real estate, REITs, I mean, these are the same things that I'll be looking at now, just at certain levels with timing. I mean, I don't take timing out of our portfolio, and neither should you. But the fact that we had Jerome Powell putting on a performance that's as good as he's put on in a while, and that is the consistency of the message. This is something the market was concerned about. Would he be able to stay consistent with the message? And he really did a very good job. If anything, I think he sounded more dovish than I thought he would. So the fact that the market sold off tells us that so much of the move higher is already betting on, factored in, discounted, baked into the cake, a lot of this tone. Okay, so he's going to keep a larger balance sheet, bullish for equities. Going to stop hiking, bullish for equities. Probably look at the makeup of the remainder of the balance sheet and try to look at the lower end of the yield curve. We'll talk about this inverted yield curve, what it is, what it means, why the market panics. And by the way, this is old news. We've had inversions, or we've been close to inversions, or that narrow space between the 2 and 10 before, right? This isn't just a yield curve panic, gang. I believe this is the market saying, what else do you got, Jerome? And that's the scary part. Okay, I'm just letting everybody know, if you haven't paid yourself, if you've been riding this higher, now would be a really good time to say, you know what, maybe I should pay myself a little bit up in this area. We are near where we've exhausted before. Wouldn't hurt. Buy on pullbacks, buy at the low of the range. We'll talk about some of those names and where we are, long crude, and a number of other things. We actually picked up some Nike, crude. We shorted Russell all darn day. Took some profits on Facebook. So there are a number of long positions we have, but I just really think it's time for everyone to look at possibly taking a little bit of profit and then buying at the bottom of the range, okay? I'll talk a whole lot more about this in the premium video. Just wanted to make a point of, where we are, and I'll see you in the next update.